Welcome to my stock portfolio update for June. If you like the content, please write in the comments below and like and subscribe. First of all, let me start by sharing with you my investing journey. When I first started investing, the book Rule 1 by Phil Town was recommended to me, and it's the best book I've read ahead of countless others. It gives you the mechanics of investing with specific criteria and details on what to look for and the metrics to use when picking stocks. I'm hoping to create a key takeaways video about the book Rule 1 later this year. Meanwhile, whilst I learned how to invest in individual stocks, I started to invest in ETFs such as the S&P 500, as well as worldwide ETFs and bonds, which have done really well, on average about 10% year on year, and these are fairly safe investments. And the best thing about ETFs is that you can put money in each month and leave them alone and let time make you the gains. But what I really wanted to do was pick stocks for myself. So whilst reading Rule 1, I wrote notes on his books and started to create my own Excel spreadsheets to help track and record the stocks I was interested in. As I started, the more I learned, the more I realised I needed to expand my knowledge and understanding of investing and the jargon used within accounting and the stock market. As I was very keen to create my own automated spreadsheet, I researched different formulas and started to collect specific financial information about the companies I was interested in. Based on the main concepts initially provided by Phil Town, but later from Terry Smith, Joel Greenblatt, Warren Buffett, Peter Lynch, and a number of other super investors that I've read or either watched their lectures about, I wanted to create a spreadsheet that was the ultimate one-page record for all the key information and metrics and will give me a detailed report about how good a company is. I'm going to share with you the companies I've bought and sold over this last year. Generally, I'll either buy and hold for the long term for a period of 10 years and beyond, or hold for the medium term, which is up to 2 years, or in the short term, which is about 6 months. This depends on the strategy that I'm wanting to implement based on the story of the company and the value I believe the company is worth. A stock I own is Capri, and my average share price is $33.92. I plan to hold this company until Tapestry buy out Capri at $57 per share, or if the deal collapses. Therefore, with a price target of $57, this would give me a return of 68% if this acquisition goes through. And at present, if I was to sell today's price, I would make a loss of 1.57%. Capri makes up just 1.74% of my portfolio. A stock I own is Estée Lauder. My average share price is $161.05. Unfortunately, I made a big mistake with Estée Lauder and I bought far too early. Therefore, I plan to hold this company until it hits my original buy price or just above it. I should have waited a couple of months longer and bought it when it hit the $115 mark. At present, I'm down by 34% on this stock, but I haven't sold yet. This currently makes up about 4.44% of my total portfolio. I purchased Fortinet earlier in the year and my average share price is $58.79. I plan to hold this company for the long term, however, I'm not totally happy with my buy price as I do think depending on the market it could go lower, so I'm prepared to buy more. My return if I was to sell now would just be 4%. This makes up 7% of my total portfolio. The next stock I own is Alphabet and my average share price is $103.63. I plan to hold the company for the long term and I don't intend on selling this stock as I think Google is an excellent company with an incredible future for further growth. My return if I was to sell today would be 84% and this makes up 23% of my total portfolio. Last year I bought JD.com and have added to my holdings since, so my average share price is $25.82 and I'm prepared to wait until JD hits my price target of $45 per share. If it was to hit this target, I would see a 90% return. However, if I was to sell out of my position today, I'd just make a return of 4%. This makes up about 13% of my total portfolio. A stock I bought back in January is Novo Nordisk and my average share price is $104. I plan to hold and possibly add to this company at the right price and I believe they are another incredible company with an excellent management team. If I was to sell out of my position, my return would be 36% and this makes up about 10% of my total portfolio. Okay, I've recently purchased more of Paycom and my average share price is $152.68. I plan to hold this company for the long term, however with all event-based purchases, meaning the company is currently dealing with adversity, there is always a risk that the stock could fall further. I am currently down by 7% at the moment, as I didn't expect them to go below the $150 mark. It just shows you can never predict what will happen next. This makes up 18% of my total portfolio. A stock I own is Palantir and my average share price is $21.31, but I plan to hold this stock for the long term. However, I do plan on buying more if they go below the $21 mark. If I was to sell out of my position today, it would make me a return of 28%. This makes up 9% of my total portfolio. I've also bought Starbucks this year, and when the price target hit $72.24. My price target is $100, but I haven't built up a full position of this stock and would like to buy more if it goes below my purchase price. This would potentially give me a 38% return. At present, I'm up 5%, and this is about 4% of my total portfolio. These are the companies I currently own in my portfolio. As I've said at the beginning, I have three categories for holding companies: the long term, medium, and short term. The companies I plan to hold for the potential 10 years are Google, Palantir, Novo Nordisk, unless their stories change. I plan to hold PayPal, Fortinet, Paycom for up to 2 years or possibly longer if I see the further recovery or greater potential growth down the line. Whereas JD.com and Starbucks are companies that could come out of my portfolio within the next 6 months to maybe a year, depending on the narrative around them. Unfortunately, I think I'm going to be stuck with Estee Lauder for quite some time, especially since they've almost gone to their 52-week low again, although I'm receiving a dividend from them, which is quite nice. And like Peter Lynch said, a success rate of about 60 to 70% is considered good when buying stocks, as not every stock is going to give you a home run. In summary, I'd like to have a concentrated portfolio, and I find it easier to manage and maintain. I tend to pick stocks based on the strategy I wish to employ or the opportunity they represent. If I'm holding a company which has reached an acceptable return, or if I can see another stock which represents a better investment, I will consider selling it. Whilst my strategy or process might not be what others like or agree with, it works for me and I'm very happy with the gains I've made. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow.